Joining us now on U.S. and global markets, including the volatility we've seen in places like France and Japan, Luke Barrs, Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management. And Luke, it's great to have you here this morning. I just wonder about the general setup here. One of the things we've been able to say for much of this year is that this equity rally has been a global affair. There's been a lot of participation elsewhere, perhaps driven by different dynamics. But if you're a global investor, you're buying the S&P 500 at 6,700 and change, what do you have to assume? What are you implicitly betting on is going to go right in that scenario?
Yeah, morning. I think first and foremost, you're betting that earnings continue to come through. I think that is what has underpinned the market progression to this point. I think we've seen, obviously, a huge amount of momentum in the last 3 or 4 months, but there is real money that's being generated. And despite all of the exogenous uncertainties, we're seeing companies still print very favorable earnings. And so we have to look at some of the dynamics in the consumer. We have to continue to think about hyperscaler CapEx and the AI trade. But we still are fairly constructive. And we think that earnings story continues through the back end of this year and into next year as well.
I've been sort of framing a lot of what we've seen over the last year or so as these idle or captive pools of capital that have just been unleashed into the world economy. I mean, obviously, we were talking about the hyperscaler CapEx, and those numbers keep getting larger. But even just fiscal expansion, places like Germany and elsewhere in Europe, Japan, now people are expecting more on that front as well. What are the implications of all that? Are we actually seeing some kind of global reflation and reacceleration?
I think we are. If we just look at global growth, we're seeing positive progression in most of those key markets. I think, again, you've touched on the hyperscaler CapEx, the AI trend. We're seeing roughly 50% increase in CapEx this year, despite all of the discussion earlier in the year around the need to normalize CapEx cycle, to focus on returns on equity and capital investment. We're still going to see $350 billion invested in that space. And over the next 3 years, we think that's close to $1 trillion. So if you're playing in that theme, if you're a beneficiary of that hyperscaler CapEx trend, that is very favorable. And then to your point on the fiscal side, we are seeing quite material change. There's been a lot of talk in Europe, obviously, around the unification of Europe, the need to drive reform at the federal level. Maybe that's been a little bit slower to progress this year than people might have hoped at the beginning of the year. But on the fiscal side, and using Germany as the example, we were looking at consolidation in Germany's fiscal position at the earlier part of the year. Now we're talking about expansion. We're talking about sectors like defense and parts of industrials driving the power grid infrastructure upgrade being excluded from that fiscal calculation. And so that gives us a lot of positive momentum, both in terms of headline growth, but also corporate fundamentals as people get the pass-through of that growth.
We have seen, of course, in response to some of this, longer-term bond yields globally. I mean, you're just coming into this week. They were moving to the upside. What are the implications there? I guess there's also a related fact with the yen weakening, that you had this boost in the dollar, which has been counter to the trend, right? We've had weak dollar and strong equity markets here.
And look, our expectation going forwards is probably to still see that over the next couple of years. We think there is a diversification, especially from some parts of the world, in terms of reserve positions in central banks away from dollar. It doesn't mean dollar is still not the reserve currency of the world, but there is a little bit of diversification we're seeing, both into other currencies as well as gold as a holding for some of those central banks. And we are seeing some of the pass-through benefits of growth measures outside the US driving a little bit of normalization in that trend. But that doesn't, for us, necessarily drive a negative outlook for equities, especially when you think about the U.S. market. Yes, there's going to be considerations around how some of the pass-through from that FX trend passes into earnings and how some of the tariff implications we've seen in the last 6 to 12 months feed through into corporate earnings. But thus far, margins look relatively healthy. And I would say, for the most part, in the U.S. larger cap space, we are seeing companies with pricing power to pass that through to the underlying consumer. And so, yes, there may be some bifurcation that comes as you get a little bit of normalization in growth and as that tariff policy starts to take hold in certain areas. But actually, for the most part, we're seeing pretty good health.
And with earnings still pointed higher in the U.S., and obviously you have the secular trends that people are excited about, that gives you comfort with valuation levels right now? Or do you feel as if they've maybe gotten a little too hot?
Look, I think we have to separate at the margin the near term and the medium to longer term. I think it's understandable from this point forwards that we will see some correction over the next 12 months. Just empirically, from these types of levels, 80% of the time, we'll see a 10% pullback over the next 12 months. So let's just put that as the expectation. But then it's also very hard to project and predict why that might happen. And multiples and valuations in and of themselves don't give us particularly significant cause for concern. yes, we see Mag 7 trading high 20s. Yes, we see the broad market trading low 20s. But actually, if you think about that Mag 7 space, there's a little bit more bifurcation across that group, but they're still, for the most part, generating real money earnings. And cash flow multiples still look fairly healthy. And so, yes, we have to be a bit more cautious around the forward outlook for growth and returns. But I would be much rather long this market than short this market. I think there's still a lot of momentum that will come through on the corporate side that can continue to drive the market, even if you're not seeing further re-rating on the multiple.